idea of the model is whatever 15-minute swing high or 15-minute swing low is rated, you're going opposite to that. Because you're thinking retail traders are going to go what? Short if they see the swing low broken. Most people would chase price. And they could be right. But then what if they are wrong? Price is actually going to reverse and go up. And when is it going to seek now? It's going to seek buy side. And it's doing it in a cheap environment below Asian Open. I preach this all the time. I sound like a broken record because it's the natural flow of the market. You buy cheap. And the same thing can be said vice versa in the other scenario being a seller. If Asian session opens and we have these liquidity pools above us and we want to be counterparty because we think retail traders are going to be wrong, it's not UJ, it's not going to be higher in value. We think UJ is going to decline in value. And if it declines, that means what? Dollar is getting weak and yen is gaining strength. That could be short term. But that's the whole idea of price going up and down for UJ. When it goes up, that means yen is losing strength, dollar is gaining strength. There's more interest into dollars than there is interest to Japanese yen. If we're going short, we're going to aim for what? Sell side liquidity. And where is that sell happening? It's occurring where? In a premium market above the fair value of the start of the session, the opening bid of the session. It's more expensive, but it's doing it in a certain way. It has to paint a story, which is why I tell traders all the time, it's very important to look at your chart like this. Look at your chart like this, time to time. It'll help you. If you can't sit here and, if you can't sit here and read the chart just like this, you may find difficulties trying to trade with indicators because indicators are not reading this. You can have them preset to do certain things, but they're not reading this price action live every minute. You're the indicator. I don't believe in indicators. That's just my personal take on it. I really do think it's a disservice to the trader, especially a trader that's trying to develop skill set. Do not use indicators. I don't see a reason why to use them. The model is a false break setup. Turtle soup, you're trying to catch a reversal. So if we look at this example and we play it forward, we see price what? Opens here and runs down and takes out this 15-minute swing low. Now, a lot of people have troubles identifying swing lows or swing highs or swing points, and it's the basis of the market. These swing points are making the market. They like the top and the bottom, of a burger or a sandwich, the top bun and the bottom bun, the top bread and the bottom bread. They make the market, and anything in between is the meats and the potatoes, The swing points need to be recognized. That's something I realized that a lot of people have troubles looking at swing lows and swing highs. And you can see I have marked off here in this blue line a swing low just before Asian Open. So to not confuse anybody. Why did Deontay mark this off as a swing low? Simply because there's a higher low on the left of this candle's low, and there's a higher low on the right of this candle's low. That makes this candle right here, the whole thing here, this point down here, the swing point. Now, normally you would like to see this swing point here, the swing low, it's high to be broken, just for it to be confirmed. But in true essence, it's still a swing low because there's still a higher low on the left and a higher low on the right. It's not confirmed because the high isn't broken. This candle doesn't come back up and take out that high. Now, it doesn't happen. It doesn't have to happen on the next candle. Not to confuse you guys. It doesn't have to happen on the next candle after this point is made. If a fourth or fifth candle were to form, whatever candle next breaks that high and it doesn't break the low, then this swing point is still intact and it's confirmed because the high is broken. Same thing vice versa for a swing high. This is a swing high because the middle point here is the highest point between the left of this candle and the right of this candle. There's a lower high here and a lower high here. This whole candle, the high of it is the swing high. There's a buy side liquidity residing over it, buy stop orders residing over it. The market is running to these swing points because there's what? Stops and orders there. That's all it's doing. It's chasing liquidity. It's chasing liquidity. And the liquidity is easily seen by these swing points, these short-term or long-term extremes. You see it on the daily time frame. You see it on the 30-minute time frame. You see it on the hourly. You see it on the weekly. And price reaches these swing points. Doesn't matter what time frame you're looking at. Once we raid this swing low here, I'm paying attention. At this point, I have an alert set. So I would have been using, and you see, I had an alert set here. The alerts allow me to stay focused, and I don't have to sit here staring at the chart all day. I have a life, you know. I care about my health. Health is really important. I want to sit here staring at my screen all day. Swing low is broken. I start paying attention and waiting for a fingerprint. I'm trying to recognize a pattern here. Recognition. I'm trying to recognize something that normally occurs over and over again. I scale down to the 1 minute time frame. And I'm simply waiting for, and that's that same 15-minute swing low. It hasn't moved anywhere. That's that 15-minute swing low right there. It's just transcribed on the 1 minute time frame. Those are the 15-minute swing highs here. And this one all the way up here. Now there's other ones on the lower time frame as well, but I'm taking a larger picture and breaking it down to a smaller picture. I don't need to take every single 1 minute swing high. I don't have to do that. But since I'm playing on a higher time frame, in order for me to get a lower risk entry, because I don't want to enter on the time frame that I'm doing my analysis on. I want to enter on a time frame lower than it. So if I'm marking up the 30-minute, it is definitely acceptable to drop down to the 15, the 5, or even lower to find the entry point. Same thing on the daily. If I'm trading on the daily, I can use an hourly to find an entry point. I don't want to use the daily for intraday trading. Swing trading, I will use the daily solely by itself. But if I'm intraday trading, I'm going to drop down to take less risk to find a better entry. This is that 15-minute swing low rated. And I'm waiting for price to give me that fingerprint. That's so important. And I'll just play it forward to the annotation. One more candle. There we go. So at this point, we have a market shift. What makes this a market shift in my definition? We have a swing high formation. 1, 2, 3. That's that swing high. We'll make it dotted and change it black. That's that swing high. That's the fingerprint that I want to see to find the entry. This is the entry. Once I see this, I know there's going to be an opportunity for price to either rebalance this area and then move towards the direction it's intended to. We can also see the market shift is occurring where? Below 8 p.m. opening price, Asian Open, 8 p.m. New York Eastern Standard Time. The fingerprint is physically forming at a cheaper price. That's very coincidental that the market shift is happening here at a cheaper price. Because at this point, retail traders are probably short. They're looking for some type of retail pattern like this. Like I said, they can be correct. That doesn't mean they're always going to be wrong. There are probably times where they take this trade and it's correct. Because there's times when I go against their trade and I'm wrong. Think about that. When I'm wrong, they're right. And when they're right, when they're wrong, I'm right. Hopefully I didn't say that backwards. Because I'm trying to go opposite to their trade. They want to sell UJ. I want to buy it once I see this. And I take that opportunity every time because that's the side and stance I want to take. A lot of people get caught up on when should I be a buyer, when should I be a seller. At one point, you have to go all in. Not saying all in full margin. That's not what I'm trying to say. I'm saying all in and as, yo, you're going to be a buyer. You made up your mind. At this point, Deontay is a buyer. There's no turning back. I'm not going to sit here and trying to convince myself now that I'm going to be a seller because I've conditioned myself to say this is the buy setup and met all conditions. I'm not going to do anything to discourage me to get into a sell. No matter what people text me, whatever people DM me, whatever people put in the channel, whatever it may be, TradingView, YouTube, whatever comments, whatever chat I'm in, I'm not going to let it get to me. I'm not going to watch someone else's chart because that could really throw you off as a trader. You're watching the next person when you can be locking in on something and you can actually find gold. You can be correct yourself. And then you back testing and looking back at your wins and be like, oh, how did I find this win? Let's try and dig deeper into that. A lot of people don't dig deep into their winners. They get caught up into their losers a lot. And this is where I find my winners. Price trades down into it. Wait for the moment of hit. And play it forward. There we go. I wanted a solid hit. So I don't think it hit it. Yeah, it came really close. It didn't hit it. But here, for sure, this candle here definitely would have been knocked in with spread. But I just wanted to show a candle that actually hits the fair value gap. Some people may say, no, it didn't count. It didn't actually hit that zone. It hit it for sure. The spread would have definitely knocked you in. I'm going short on the first touch of that fair value gap. So we look on the lines like this. And so let's say it was this candle I went long on. I'm risking anywhere from 1% to 2% of my equity, of whatever my balance is, my total balance of equity that I have allocated. I'm risking 1% for the trade. I'm going to take a stop loss of 15 pips. And I'm going to take a TP of 15 pips. A very basic 1-to-1. Oh, I got to sneeze, man. No, I got to sneeze. Now, you can see this 15 pip target is ideal. Now, why is this 15 pip target ideal with where the market shift is occurring? Because even though I may get this market shift, let's say in 15 pips from here, there was no equal highs, because you can see these are clean highs when the 15-minute time frame, but you can see how all these highs here are relatively equal. Even all these here, all these up here, these are all relatively equal highs. You could see someone drawing, a retail trader drawing some type of trend line and trying to convince themselves that this is the trend line. Oh, I just broke the trend line. Then I'm going to buy the trend line. You're going to see all people do all these kinds of things. We can see these are all relatively equal highs. They don't have to be exactly next to each other, but they're all close. All these highs are close to each other. So these are all equal highs. You got a little phantom trend line going on here. Price trades down into this. And if there isn't a 15-minute swing high that's nearby, the trade setup may not be ideal. Even though you get that fingerprint, this is a hard pill for a lot of people to swallow. Even though you may get that fingerprint, at this point, when you start framing the risk, if it doesn't work out because of what you're granted on the chart and previous data, what you have to the left of your entry, don't take the trade. You would have to abort. Because if it's outside of your risk parameters, how could you take the trade? You don't have no feasible targets. And this is 15 pips for you, Jay. That's 15 pips. There you go. So 1-to-1. I'm risking $1 to gain $1. I'm risking 1% of my equity to gain another 1%. But if I lose, I'm only losing 1%. Now I could do that with a 0.5% instead. Let's say I only wanted to risk 0.5%. I could do that. Or if I'm risking 1%, I could break it up into 2 trades. Take one trade 0.5%, wait for it to run into profit, find another entry, take another trade that's 0.5%. And at that time, at that point, you would have some kind of buffer because you've already got a trade running in profit for your second entry. You're most likely not going to take 2 entries right there in 1%. You want to take 0.5%, and then probably wait for that to get in profit, and then use that buffer to find another entry point to potentially go higher. You could pyramid your trades. A little more advanced until you get comfortable. I wouldn't say any starter is just going to get in here and start pyramiding trades. This trade is feasible because this 15 pip here target has what? These involved. It's within proximity of these swing highs. So I like this trade setup for sure. Even my swing low. If price were to get down here, all the way down here, I wouldn't be surprised if it went back up. It didn't hit my full stop. Now, a thing with risk though is a lot of psyche that comes into it. So you might get psyched out. That's a real thing. You can only imagine a human being sitting behind their computer or looking at their phone taking a trade and seeing candles drop down here. They most likely would get out and do what? Sell. That's what I said. I don't want anything else to try and unconvince me to get out of my buy, because there are many times where people see this happen and they're in drawdown. If price ever goes against you in drawdown and you start sweating, you start tapping your foot, you start gritting your teeth, biting your teeth, tapping your fingers, tapping your foot, you most likely risk too much. I've been there. I've done it. You're looking at it and you're like, turn around, turn around, turn around. And you're like, yo, price, please go up. I would never risk this much ever again. And then it continually runs your full stop. And then you lost 5% of your account in 1 or 2 trades. Now you're way behind again. You're wasting time. It's not efficient. That's why the steady pace is much more safer. Hey, you could take risk, but please do it within your means. Don't just risk anything you don't have anything to fall back on. And you got to understand when there's a point where you got to take a break from trading. There's going to be a lot of that. Any professional trader would tell you they would take a break from trading. Or there's moments and times in their trading plan they don't trade. They're relaxed. They're not as stressed. Trading, even the best traders in the world still will find unnecessary stress. It's how you manage that stress. How often do you get stressed? There's a lot of things to talk about. But this is the entry. 15 pips up, 15 pips down. You play price forward. And you can see immediately almost hit TP. Didn't take too long. Did not take too long within this zone. Now there's going to be moments and times you go through all the episodes of the Asian Session Library. And I'm going to post this on YouTube as episode 17. I believe we're on episode 17. And you'll notice there's some examples where you do get a little bit more drawdown and then it comes back. But like I said, that's all you believing in your trade. Do you believe UJ is going to gain value within this time period? And I do, according to what I've planned out as the model. None of these examples are different. This is the same thing as episode 16, 15, 14, all the way back down to 1. Very similar. The earlier ones, like I said, I was using the very first fair value gap that formed in the opposite direction. And what that would have looked like was this. Let's see. So the very first fair value gap that forms after this 15-minute swing low breaks. Do we get one? Where do we have one? Here. I have one right down here. And in this example here, this one would have been the best entry possible. It's a very early warning sign here. Now, many people might say, oh, there's a balanced price range here, BPR. You got a fair value gap here, down. And then immediately after this fair value gap down, a couple minutes later, we got a fair value gap back up. So it's rebalanced. So what did they do? They essentially trapped sellers. So underneath here. And this is very familiar with a lot of ICT teachings. You got a balanced price range here. They've trapped underneath this here. You could see it right underneath here, at least from down here to here. They've trapped all the sellers. Everybody got trapped, and they just brought it back on them. And a lot of people will sit here and be at awe, They'd be like, oh, crap. Price just turned around on me very fast and aggressively right after this fingerprint too. Fair value gap, price trades down into it. Now, yes, we see it trade past the zone here, and that happens. And you might even have a candle that closes below it. I'll even go that far to argue that as well, because I feel like a lot of people will sit here and say, ah, but it closed. There's a candle that closes below the fair value gap. It happens. Look at this. I try to tell people this. Oh, dang, got a message. Hopefully, I'm muted. I actually got to mute the chat real quick. I apologize. One. How do you mute this thing? To mute and mute for 1 hour. I think I muted everything. I should be good. Sure. This candle here, I apologize, folks. This candle here closes below that fair value gap. So I definitely argue that. And friendly arguing, you know, there's as a debate. I don't want to get into the yelling arguments. This trading community can be really extreme. People really don't agree with your idea. And I could care less if you don't agree with me. It's just my opinion. Candle closes below that fair value gap here, but still price goes up. And then I that's why I don't agree when people say once price closes below the fair value gap, you no longer use that fair value gap. I don't believe that, because it's still trading within that zone, and this was the risk I permitted. So even if price were to drop lower, I'm permitting the rest of this risk here if I'm gonna hold all the way to SL hit, or even if I get out before SL hit, because there are times where you may cut the risk earlier than later. You may get down to 50% drawdown and say, you know what? I'm not really feeling the trade. I'm getting out. Some gut feeling, whatever it is. I'm getting a lot of messages. 1 second, folks. Okay. I found this on the web. Turn on Do Not Disturb.
Okay. I turned on Do Not Disturb.
Cool. Hopefully that didn't cancel the Zoom. Can you guys still hear me? Just want to check the chat and make sure somebody was messaging me. Thank you, guys. Thanks for those that have joined and are participating. I really do support. I want you guys to win as well. I just want you guys to see it from my point of view, because I think it makes sense in the way, at least I try to teach people the best way possible and try to keep it very simple for people to understand. There's a lot of confusion out there. When I look to other people for guidance as well, I do see the gaps. And I'm not sitting here saying I'm perfect, because I'm not perfect. I'm totally not perfect. I'm still striving to be perfect, but I think the way I explain it, it really makes sense. So I really do appreciate you guys spending time and listening to me here. Your time is very valuable to me. And price continues to go up. This here, that's that very first fair value gap. That was that entry here. This is in the earlier Asian session models or libraries. This was the entry I was telling folks to take. Or at least that's what I was taking, at least when I was trying to teach it to other people. I was saying that first fair value gap, I want that. And in this example, it would have been great because it's a lower price point that you're buying at. And it's always ideal to buy what? Cheap. And you can see this buy was much better than this buy from entry point. Very first tap, SL 15 pips out down, TP 15 pips up. You would have smacked 15 pips by then with this entry, at least. See, 15 would have been here. You see how different that is? Really efficient. But I don't really like this anymore. Even though it may come up, I don't use it anymore. I'm very strict now to stick with this. Who knows if I may go back to this once in a while. But this I've found to be really consistent. This tends to be inconsistent sometimes. So I don't use this. You can go with this. Not to say you can't choose this for your model if you choose to, but I would prefer traders to wait for this. It gives you much more time to see what price is going to do as the Asian session breathes. As the hour going into 9 o'clock right here, You got more time. By 9:30, I tell people this all the time. It's funny because people think, like, how do you know by 9:30? It's just something you know as you keep studying. By 9:30, normally I'm done trading. No joke. Like 9:30, like if normally the session will start around like 8:15, around 8:30, the model may show itself. Maybe a little later, but typically I have like a time period where I see the entry would occur. This one happens a little later. Even though I still believe here the spread knocks you in. Spread would have knocked you in here. Yeah, spread would definitely have knocked you in here and here. But overall, the entry here, when it fully crosses into fair value gap, was a little later after 9, which isn't bad. But as we see 9:30 comes around, 9:30, right around here, price starts to really start pushing. Again, another new leg starts to push up. And then you start going into that hour 10, go into 10 o'clock right here. And at that point, Asian session has only 3 or more hours to finish. And I mean, 2 more hours to finish, and that's it. So, yeah, this is the Asian session model. And if you play it all the way out, just to show what happens, I'm going to play it till 12 a.m. in the morning. Right here. Cool. That's 12 a.m. That's if the true day open. So, this is the session right before London. So, another dead period that I personally wouldn't trade. But look at how it's so interesting. I'm telling you, when you study price action, it's interesting. People don't love the charts as much as they think they do. Look at the price action. Look at how it hits Asian session openings price, and look at how it rallies away. Not saying that's a buying opportunity or something that would be looked at as a buying opportunity, and it does look like a very good buying opportunity as well. You can see how price continues going up, trading off a breaker. You got an ICT order block theory going on here. Price coming up, coming down, shooting right through that really fast, trading back down into the candle here in a discount, and then rallying back up to those highs. And it gets to that final 15-minute swing high here. That's very interesting there. The market is very mysterious like that. But look at how it trades below Asian Open. That can't be a coincidence. Even prior to that, look at how it's like threading the needle between the open of the session. At the beginning, it completely takes people one way. It tears off low quick, really quick. And with that action there, that swoop down, you got them. You got them. You know, it's like the banks. They're like, we got their money. We got them. They locked into sells. And foolishly, people go all in and they risk everything on that one move going down, no matter where they are on, like, the cyclical like cycle of greed and money, they risk everything. And then all of a sudden they're like, we're winning, we're winning, we're winning. And then, but then optimism comes in. So they hold the shorts even longer, right? Or they even increase their stop loss. And let me hold for 10 more pips. Let me hold for 20 more pips. This is real stuff that I'm talking about. People do this. You get into the trading community long enough and you ask around, you hear what people do. People have all done this before. Let me hold the trade for 10 more pips. Let me hold the trade for maybe 15 more seconds. Whatever it is, they're trying to buy time. Nah, it's gonna turn around. It's gonna turn around. I promise you. Just take the signal. That's all nonsense. It's optimism and it's foolishness. You're not objective enough. And as you progress as a trader, you'll see you gotta kick yourself in the butt. You gotta tell yourself, stop. I can't do it no more. I'm done trading for the day. I made 30 pips. I made 40 pips. You're on fire. You're good. Why do you have to go back in more? You don't. And this is essentially Asian session model. This is episode 17, The same model. It's crazy when I see this, and it's really amazing me to see how many times I'm able to show this model. And it doesn't just happen on UJ. It happens on all other pairs. All the other pairs also do this. More frequently, I would say it happens on the yen crosses. Do your due diligence, of course. I'm not sitting here telling you, oh, it's only the yen. I would prefer people to trade the yen because it makes more sense. You're trading there in Asian. The yen is more popular then. And dollar may not be as more popular in Asian session, but since this one is crossed with the yen, you can do that. Now, I wouldn't sit here and say trade, oh, go trade UCAD during Asian session or go trade U Swissy during Asian session. There are times where they will permit 30, 40 pip runs in one direction, and you were able to catch that. But there are times where it does consolidate. The Asian session still has that narrative of consolidating. The overlying characteristic of Asian session is to consolidate, to prep for the new trading day. This is the last session. Think about this as well. This is the last live session before if the true day range open, 12 a.m. The market is now going to be keying off of the Asian session low and the Asian session high for London and New York. It's going to do that. The Asian session is very important. As much as people don't like trading it, I think it's something worth your while and worth studying. And it may be something that you really like to trade and it works out for your lifestyle.